All right, hey everyone. It is 1:20. The market's just closed up. Let's take a look at what they did and kind of where we're sitting. Okay, let's start with soybeans. Not a whole lot of news on the soybean market this week, other than purchases came through. I think every day, maybe just 4 days. But we got new purchases. Demand looks really pretty good, and the market's trying to digest what the yield is. So Sunday night we opened up with this big gap up, and then we reversed it, and we pretty much closed on the low of the week after that. So this formation right here, these three bars, you got to. This is a long upper shadow, bearish engulfing. Then you have three bars here with expanding real bodies. And remember, the real body is the red part. This is the open, this is the close. Red just means it closed lower than it opened, and each body got bigger. So that's what we call three black crows. And today, today really could have turned ugly if this market had bit on that signal and taken us lower. What I don't like is that we were unable to break above where we were 26 days ago. I don't like that we traded back inside the daily cloud, and I don't love that the leading edge here is falling. I don't love any of that, but I do like the fact that the 9-day is above the 26, and that this is a 5-wave move up right here. So you can count it very simply: 1, 2, 3, 4, 5. That's 5 waves up, and now we've retraced down. Let's put a retracement tool on here so you can see exactly what we've retraced of this rally. We have not even retraced 38.2% of it. So I think beans look really good for higher, notwithstanding the three black crows. If you look at a 240-minute chart, well, what did that do here? That's not the 240. There's 240. So if you look at the 240-minute chart, it has yet to really roll over. We just sort of challenged the bottom side of this cloud here today. It's in a wave 2 position. If you look at the 360-minute chart, it looks even better. It hasn't even broken into its 360-minute cloud. And the 60-minute, it looks worse because it's moved sideways. The other thing that's interesting about this chart is notice how really sideways this whole move is. If you look at the daily, it looks like we gapped up and just went straight back down, right? But really, we've chopped and we've slopped and we've been very, very sideways. Really, the only selling pressure has come in the first hour of the last 2 days. So this is 8:30 yesterday morning where the market just got smoked, and then this is the 8:30 bar from this morning where the market got smoked again. Other than that, the market has sold off a few times. Like this is 7 p.m. to the morning here the other day, but it really hasn't just. Sorry, this is 8:30. This is the day shift here the other day. So you've got selling that morning, you've got selling in the morning here, and selling here. So I don't know what that really means, other than somebody's been unloading positions, whether that's funds or commercials or whatever. I think this week, really, all the markets were confused and pressed with September moving into delivery, and these December and November contracts becoming really kind of front and center. But if you look at this, it's really pretty sideways. It really hasn't been super impulsive, and so it's not something that we're overly worried about. Again, 360-minute, 240-minute, and then your daily chart all really look pretty good. If I pull this back and look at the weekly, it's not going to look pretty because that's a big hook reversal. But we're still on top of the daily cloud, and really this is just a pullback. So we've got a 1, 2, and now we're up in 1. Daily chart, you've got, this is all 1, you're down in 2, and now you're up and down. And on your shorter term stuff, you're down in a 2. So you've got a series of 1, 2s, 1, 2s that you're working with, right? 1, 2, 1, 2, and this thing should get rocking and rolling and get up and out of here really, really quick. So we're carrying positions. We sold some calls against it just to get some theta over the weekend, and if we do open up lower, we'll end up exiting futures and looking to buy them cheaper. But other than that, we are looking for higher, and I hope we have to buy in calls at a loss, but that's okay. All right, let's look at corn. Like soybeans, it really didn't do anything all week. This was Monday, opened higher, ended up coming lower Tuesday, Wednesday, Thursday, but didn't violate any resistance. This level continues to hold, and these divergences continue to grow. So we're looking up in corn. I know that there's so much negativity surrounding corn. I even heard one guy talk. Phil was listening to a podcast, and the moron that was talking just kept saying yield doesn't even matter. 161 or 181, yield is irrelevant. The spreads are at full carry. We're going lower because demand is that bad. And I think that is just a complete imbecilic statement, because yield does matter. Supply is everything. It's literally half the equation. Supply and demand. Demand is equally important, but supply cannot be minimized. And when you have a market like this one that supply is shrinking, you just cannot ignore it forever, because demand tends to show up when supply appears most vulnerable. And we've started to see that over the last few weeks between energies, and we're seeing that in the demand cycle as well. So I wouldn't be a bit surprised to see demand pop rear its head and really get this thing going. This market looks and feels eerily similar to summer of 2020, when everything looked bleak. Demand was bad, COVID was bad, crops were big, and yet we shocked everybody and came higher. These divergences are equally big compared to then. And I'm not saying we're going to $8. I'm not saying we're there, but this is not a market that I'm interested in selling in any way, shape, or form. As a speculator, I do not want to touch it, because I think you might catch a little bit to the downside. But look at this, 1, 2, 3, 4 massive bearish reversals. In this market, best case scenario, you caught 30 cents. This market has not moved, and the last 3 have not gotten anything to show for it. In fact, if you sold late in those days at the closes, you are a whopping 5 cents in the money on any one of those short sales. And if you sold on this day, you are actually even. So you've gotten no bang for your buck after selling all of those reversals right there. So I think that market is showing great resilience and not wanting to capitulate. And with beans and with corn, with where we're at, I just don't think that being sold is the right place to be. Now, let's talk about marketing for a second. So if we're that convinced we're going up, are we lifting hedges? No, because the market hasn't given us a reason to. We're not going to really do anything aggressive with hedges until we break these highs, because then that's when we're going to work ourselves higher. We haven't even rolled these puts down yet, because we don't want to get exposure to any more time decay than we need, and we've got these puts, if we do roll over, they're going to pay out really nicely. Volatility will increase potentially, and we'll be able to move them lower at more efficiency. So we're going to leave hedges where we are. We're not going to do anything crazy, but we are looking for opportunities to buy this market and get longer, because of the way it looks, because of the way it feels, because of the volumes, the divergences, what we're seeing in supply, what we're seeing in demand. All of it has got to line up. Just one 50,000 foot thought. If you're a technically based systems trader, that's great, but the most powerful technical signals are in line with fundamentals. So you can't be just naive to them, because you're not going to rally a market $4 or $5 or $2 in a economic situation that's really, really bearish. You're not going to do it. And likewise, you're not going to sell a market off to new contract lows in an environment that's pretty bullish, where you have shrinking supply and rising demand. You're just not going to do that either. So can we break lower? Yes, but we're not going to go lower and sustain it without some major shift in fundamentals, in our opinion. All right, now let's talk about wheat, because wheat had a big nasty day today. Don't like anything about this close. And the only thing I'm going to say that's positive about wheat is that it's Friday of a 3-day weekend, and it capitulated kind of on in the last 3 hours of the day, and it did that on some news out of Russia that maybe they're going to come back to the wheat table. But what this did is just grow in divergences. So this is a massive bullish divergence. If we look at the stochastics, that's a nice divergence here. RSI, nice divergence there. Force index, spectacular divergence on force index and MACD. All of our oscillators are pointing to that this move is finding exhaustion, and today is a day that should be pretty much ignored, and we're looking for re-ownership. You know, earlier today we talked about kicking out a rec to re-own wheat with 780 calls. I still think that's a really good good place to do it, because if we do rally back up and break these levels, then we're coming above 780. I don't know how high we go, but we're coming north of that. Probably depends on corn and what yields end up being when we get into the fields. But I don't think wheat has a lot more left on the bone to the downside. With these divergences, I think we got to work higher first. So there have been multiple times where I've rolled over and capitulated and sold these divergences like this, because man, it just feels like it might just drop another $5 on us. And every single time you end up getting smoked, and you have to and you have to cover those shorts, because these divergences are very powerful signals. The problem is sometimes they just don't catch. Like today, it could have caught. You just don't know when it's going to catch, but it behooves you to keep betting on those divergences and stay in that game until they actually do present themselves. Okay. That's 11 minutes. Frustrating week, frustrating 2 weeks. It's been a difficult market to trade, but then again, you got to feed. Bulls have to be fed, and you've got to feed these markets every day, and they haven't been getting the demand news that they need in wheat and corn in order to go higher, and so that puts a lid on beans too. So hopefully that turns a corner and comes into effect, and we get some higher markets next week. But I think Tuesday, Wednesday is going to be pretty wild, and I think there's just going to be a big tug of war between bulls and bears here to end the year. So I think the next 90 days are going to be really exciting. All right, that's what we got for you this week. Remember, there is significant risk of loss anytime you trade futures and options, and you should only do so in light of your own financial condition. I hope you guys have a terrific holiday. We will be back with you on Tuesday after the market gets a full day of trading in. But stay tuned to your texts and emails for any intraday updates that we have after the open on Monday night. Have a great night. We'll see you later. Thanks.